Imagine this. You're sitting at the dealership, you've picked out the absolute perfect car, you're running the numbers, and then, bam, you get rejected for the loan. Or, honestly, picture something even bigger. You're buying your dream home. You actually get approved, but then you find out your interest rate is astronomically higher than someone else's. And here's the absolute kicker. You're buying the exact same house for the exact same price, but you're going to end up paying thousands of dollars more over the life of that loan. Now you might be wondering, why on earth does this happen?
Well, it's a completely heartbreaking reality for so many folks out there. But getting rejected for that dream home or being forced to pay a massive premium on a mortgage almost always boils down to just one underlying reason. It's this fundamental piece of our financial system that, frankly, a lot of people just completely misunderstand. You see, it isn't about how much money you make, and it's not even about how much cash you've got stashed in the bank.
The real reason for that rejection, or that totally sky-high interest rate, is one single hidden number. Yep, your credit score. This one little 3-digit number holds immense power over your entire financial life. So today, in this explainer, we're going to completely demystify it. We'll break down exactly what it is, how it actually functions, and most importantly, how you can protect your wallet.
Okay, let's dive into this. Here's our roadmap for today. We're going to cover the hidden financial number itself, how your score actually works, the 5 major factors that make it up, common credit mistakes you definitely want to avoid, and finally, ways to improve your credit score.
All right, Section 1, the hidden financial number.
So what exactly is a credit score? Basically, it's just a number that lenders use to estimate how likely you are to actually repay borrowed money. It's kind of like the ultimate test lenders put you through to judge your borrowing reliability. Generally speaking, these scores range from 300 way down on the low end, all the way up to 850 on the high end. Think of it as a financial grade that summarizes your borrowing history.
Now, having a higher score, that's like a financial VIP pass. It dramatically improves your chances of getting approved for loans and credit cards, and it literally qualifies you for significantly better, lower interest rates. On the flip side, though, a lower score makes borrowing incredibly difficult. And even if you do get approved, it's going to be so much more expensive.
Moving right along to Section 2, how your score works.
See, this isn't just about those massive, once-in-a-lifetime purchases. Your score impacts your everyday life. We're talking credit card approvals, car loans, mortgage applications, personal loans, and honestly, even rental applications for an apartment. When you realize that even a tiny, seemingly insignificant difference in an interest rate compounds into massive costs over time, you start to see exactly why optimizing this number is absolutely crucial.
Which brings us to Section 3, the 5 major factors.
Now, what's really interesting about this is that your score isn't arbitrary. Lenders don't just pull it out of a hat. It's actually calculated using 5 very specific factors: payment history, credit utilization, length of credit history, new credit applications, and credit mix. Master these pillars, and you master your score. So let's break them down.
First up, we've got payment history. And guys, this one is massive. Simply paying your bills on time is literally one of the most important habits you can build for a healthy credit profile. Why? Well, because your payment history is the ultimate proof to a lender that you're actually reliable enough to pay back what you owe.
Factor number 2 is credit utilization. Now, this just means how much of your available credit you're currently using. So say you have a credit card with a $10,000 limit and you spend $9,000 on it, you're using a huge percentage of your available credit, and doing that actually lowers your score. Financial educators are super clear on this. Keep that utilization relatively low. Just don't overextend yourself.
Okay, grouping the final 3 factors together, we've got length of credit history, new applications, and credit mix. Older accounts are great because they establish a nice long history. Then you've got to pace yourself with new applications. Applying for a ton of credit all at once can really hurt your score. And finally, having a good mix of credit types, like maybe a credit card and an auto loan, actually helps build up a well-rounded profile. All right, let's look at Section 4, common credit mistakes.
Now that we know how it works, let's talk about the pitfalls. Because so many well-meaning people accidentally drag their scores down through really simple oversights. Things like missing payment due dates, even just by accident. Maxing out credit cards, which, as we just saw, completely wrecks your utilization. Applying for way too many cards at once. Or, here's a sneaky one, closing long-standing accounts without realizing that you're blindly wiping out your good history. Oh, and of course, simply ignoring your credit reports altogether.
which perfectly tees up Section 5, improving your credit score.
So the crucial point is that you can totally fix this. You have the power to build sustainable habits. Here's your concrete roadmap for improvement. 1. Pay your bills on time, every single time. 2. Keep those credit card balances nice and low. 3. Review your credit reports regularly so you catch any weird errors. And 4. Just avoid unnecessary credit applications. Keep it simple.
Now, I do want to set some realistic expectations here. As the saying goes, improving a credit score usually takes time, not days. Rebuilding your credit is a marathon. It's all about small, consistent decisions, not some magic overnight fix. So you just have to be patient with the process.
And I really want you to remember this fundamental truth. A credit score isn't about being rich. It's about demonstrating responsible borrowing habits. That's it. It's a measure of responsibility, not a measure of wealth. Literally anyone can build an amazing credit score if they just stick to those reliable, consistent habits over time.
So, I'm going to leave you with this one final provocative question to chew on. What small financial decision will you make today to protect your tomorrow? Because those tiny, consistent choices really do compound into massive results over time. If you found this explainer helpful, go ahead and hit that subscribe button for more easy-to-understand personal finance content. And hey, share this explainer with someone in your life who wants to level up their financial knowledge. Thanks for hanging out with me today.